So my name is Josh Garland. I'll be the host of today's show here. I've been with Apriem for just over 4 years now, but I got my start in the industry back in 2009. I am a chartered financial consultant and an accredited investment fiduciary. And then on my side here, we'll start with Benjamin Lau, our Chief Investment Officer, or CIO here at Apriem Advisors, with over 2 decades of experience in the business. Ben has been featured in the Wall Street Journal, CNBC, Bloomberg, Investment News. So we're very, very blessed to have him. And then at his side, we have Jose Rendon, who is our Senior Portfolio Administrator. Now, Jose actually sits on the board of the Finance Department Advisory for his alma mater, which is Cal State University of Long Beach. With that, I'm going to go ahead and hand it over to you guys and let you take it away.
Thanks, Josh.
Yeah.
Wow, what a crazy time, right? In the markets. Last year was a pretty crazy year for the markets, right? And so far, thankfully, this year, 2023, is starting off a little bit better. Markets up a couple points already so far in the first few weeks of the year, but it's been a wild ride, right? And so we did want to spend a little bit of time talking about last year and going so quickly over some things, and then really spend more time talking about some of the big questions that we're all facing, for the rest of the year, maybe for the next couple of years, especially how it impacts the economy, but really how it impacts your portfolios and your financial plan. So, but before that, let's talk real briefly about 2022. What happened last year, right? And last year, this was the whole story for what happened last year. It was finally, after many years of easy money, it was the end of the era for easy money. And due to the higher inflation that we all saw and all experienced, whether we pay for it at the gas pump or at the grocery store, energy inflation was moving up relatively higher last year and rather quickly. And so to combat that, the Fed that found itself quickly behind the 8 ball here and behind the curve, and really had to start raising rates dramatically at the beginning of the year. And you can see that huge spike in interest rates here. And this is a chart of the Fed funds rates you can see over the past few decades. But you can see almost for much of the past 15 years, interest rates have been quite low, under 2.5%, and then even lower post-COVID. But since then, since for about the last 12 months, the Fed has been raising rates dramatically, and now Fed funds is slightly over 4%, and possibly going even higher as for the next few months. But that was really the big issue, right? That the higher inflation really led to higher interest rates across the board, and that higher interest really led to a whole reset of valuations for everything. Right, whether it was for stocks, for bonds, for real estate, for cash, when the cost of capital for many companies does go up, people, investors, market participants will reevaluate what they're paying for everything and how they value things. And you can see some of the things that got hit some of the worst were things like stocks or speculative assets that didn't have any cash flows.
And correct me if I'm wrong, Ben, but it wasn't just how high they raised rates. It was how it was the pace, right? This is is this the fastest pace we've seen them increase rates?
This was, and that really is a good point, Josh, right? And you can see here in the past, interest rates have gone up, right? And interest rates have been higher during past market cycles, but usually the Fed's been more gradual with their approach. The issue that we had last year was how quickly the Fed would move rates. 75 basis points was almost unheard of for multiple meetings. And so that pace really caused a tremendous amount of volatility in all equity, on all asset classes. And it really kind of broke some things along the way. But yeah, it was the pace of how quickly they rose interest rates, not the fact that interest rates went higher. You can see that with mortgage rates too. So what happened though? So what does that leave us? And so this is what we charted out the performance for several market indices over the past few years, right? 2020, 21, and last year too. And so we charted off large U.S. stocks, as the S&P 500, international, emerging markets, bonds, and real estate. And after a few good years or decent years, last year we saw a year where everything fell, right? It doesn't matter almost anything you're in outside of cash. Everything fell. Stocks fell by about 18%. International was down north of 10%. Emerging markets were down over almost 20%. Real estate was down over 20%. But the surprising thing, the surprising asset class really in yellow was bonds, right? Bonds, usually the safety part of the portfolio was really, got hit really hard. They were down double digits last year, and they saw one of the worst years for the bond market in the last 100 years. So that was probably the biggest shocker And in a year like last year, kind of like what we saw in 2008, diversification didn't really help too much, right? It helped a little bit, but the bonds didn't really provide that balance that we've become used to, and so that's why almost everything across the board had a rough year. So
it's green, by the way.
Oh, green. Sorry, the yellow is emerging markets. The green is U.S. bonds. Sorry. So where did that leave us? Like Josh said, with the highest inflation reading in 40 years, that led to the fastest interest rate increase regime in history. Mixed in there, of course, besides interest rates, we saw a huge amount of geopolitical concerns coming out, mainly out of Ukraine and Russia, but in other parts of the world too, and especially with China slowing down and then restarting back up. That led to a real change in consumer spending, right? And after a couple of years of COVID spending, consumers still continue to spend, but they changed what they were spending on, right? And we saw that really, if you went to Target or Costco or even went to the airport, right? People dramatically shifted from buying more and more goods, or less and less goods, and travel and more services. And so that was a huge change in consumer spending that we saw throughout the year. And then the last thing that we talked about a little bit, but that didn't impact us too much, was this meltdown in cryptocurrencies, right? And we saw that across the board, especially accelerated with what happened towards the end of the year with FTX. But it wasn't just crypto, right? It was a lot of speculative assets that did well when interest rates were zero, but when interest rates started rising, I think some of those speculative assets got hit a little bit. And not just crypto, we talked about some of these consumer-facing names like Zoom, which are on now, and Peloton, and some of these EV companies. They all got hit pretty hard too, but we've been able to avoid most of those by and large.
Yeah, I would like to point out, so we did a crypto webinar last year where we talked through that crypto, how it works. It was so popular at the time, a lot of questions. And one of the key things we talked about was the importance of position size, not overexposing yourself. And it was really easy. And I know a lot of people that got wrapped up in the crypto craze, right? And you get too much of your portfolio into any one area, no matter how great it looks like it's going. That's why it's so important to pay attention to our position size and our diversification.
So the real point of this webinar really today is to talk about what all of you have been asking us, right? And everything that's really top and center of your minds, especially as we look at the economy and then how it relates to your portfolios, right? Enough about the past. We've already talked about that. Most of you lived through the past. Let's talk more about the future, right? And the biggest issues that we have, or the biggest questions on our mind about the future, especially for the next few years, relate to this to a reset. We think that we're going through an interest rate reset right now, and that's going to lead us to go through a couple of things, right? And so the biggest concern, at least that I get, is are we headed to recession? We think we are, and we'll go through some slides to talk about that. What's going to happen with employment, right? Because a recession is one thing, that's an economic phenomenon, but really, does that impact my job? And so what's the state of the job market here in America, and how strong the unemployment is, and how much people have saved up? Consumers have still saved a good amount of money during COVID, and how is that holding up? And it can allow them to continue spending. And then ultimately, how it really impacts us in our portfolios is how are earnings doing? How are the profits of the companies that we own? American household names, how are profits holding up? How are their earnings holding up? And will it let them grow? And then what's our time frame? What's the time frame for all this?
So if you could, just for the sake of everyone that's listening, what is a normal curve? What does that mean when we say a normal curve?
Yeah, great question, Josh. A normal yield curve is pretty close to what the orange line is like. A year ago, we had a fairly normal curve, and one of the biggest things that investors ask for is higher compensation for longer term investments. And it's only reasonable that you get paid more on an investment that is 10 years compared to something that's 1 year out. But if you look at that blue line, you're actually capturing a larger yield on shorter term investments compared to those that are 10 years out. So why wouldn't you want to capture higher yields for the next year? And to us, this is really an indication that there's a bit of uncertainty about what the future is going to be like. And the biggest thing really compared to last year is that investors are expecting now a lower inflation, and that's one of the reasons why the longer term yields are smaller than the near term.
Yeah, I mean, this is a great thesis, right, as a good predictor for recessions, right? And the Fed really controls what we call this front end of this yield curve. Say anything 2 years and in this front part here. As you can see, the Fed would keep the interest rates low, and now they raise interest rates, and that's why you see this bulge here, this yield curve here. But this lower part here is really not really dominated by the Fed, right? It is really dominated by investors like us, pension funds, endowments, and they're the ones here that are the buy here, right? Mortgage providers. And so something's telling us that the Fed is pushing rates higher, selling bonds and moving interest rates higher. But like I was saying, the longer rates have not moved as much, not nearly as much. And so someone's buying this long end, right? And saying the thing of that. And that's what the market is saying, that, man, I want to lock in these higher rates now because I think that a recession is coming. And so that's why usually the yield curve is a great predictor of recessions.
Okay, and so if I could just regurgitate, essentially what's happening here, right, is that if the market as a whole is expecting that we're going to go into a recession, right, and you guys can see the significant amount of the blue line is substantially higher than where the orange line was at this time 1 year ago. But instead of taking and locking in, or just taking a bet on something that's shorter term, 1 year, 2 years at roughly 5%, they're saying, hey, I think rates might go down later on down the road. So to have a 4% that's locked in for the next 10 years is more valuable than having 5% that's locked in for one.
Exactly.
Right? Because in 5 years from now, a 4% rate might not exist anywhere again.
Exactly. So we see a lot of big buyers want to lock in higher rates now.
Okay. Looking at this chart here, we can see the red bars that are going up and down, right? Those are indicating recessions. And you can pretty much see that this is throughout history, it's been very much the case that any time that LEI, that index itself, drops below zero, the preceding months, we end up falling into recession. And right now we're well below that. But this is an index, right? So it's composed of a basket of data that's in there. What exactly is in this LEI index itself? What's included?
Yeah, great question, Josh. There's two big bits of data in the LEI, and it's really financial and non-financial data. One of the biggest components, which we all know, is the S&P. What are stocks doing? On the non-financial side, we're looking at consumer expectations. What do consumers think the future is going to be like? And also new orders. What are manufacturers looking and expecting to see in the future? So two big sides of the coin. Really, the only silver lining here on the latest reading for the LEI is that the biggest reason for the drop was that prices were dropping compared to a drop in the orders portion of the index. And what this is telling of is that the interest rate hikes by the Fed are having the correct effect for the economy, which is bringing down prices.
The predictor, the accuracy of this index is pretty dramatic, right? And you see here that anytime the growth of the LEI goes negative or into the red here, we have this recession, which is these red bars, And what's more surprising to me is a couple of things. Number one, before the great financial crisis, the LEI turned negative by about 2006. So it was early, but it did point, and that was in the 2006. I mean, everyone was buying homes, and that's what the economy was still rip-roaring in 2006 and 2007. But that's when the LEI started turning negative. So the LEI did show some weakness in the economy quite early on, before the GFC hit in. Also, conversely, the LEI also turned negative in late 2019, right, before the COVID period. So something was coming out. I don't know what it was, but the LEI knew something before we hit to the peak COVID craziness in March of 2020. So it's been a pretty dead on indicator for recessions.
Great. And moving on to another indicator is the ISM manufacturing EMI, which again is pointing to us or flashing for a recession. And we can see that the PMI has a red bar in the middle, which is pretty much like a neutral level. And anytime the index falls below this, it's indicating that it's in contraction territory. And above that means that it's in expansion territory. And if you look around the periods of 2012, 2013, and even in 2016 or thereabouts, the index did fall below, but again, as Ben mentioned, there was no recession during this time. And just because the index fell below it, it is an indication. But what really is how profound was that drop? And clearly in '08, there was a huge drop there. It's noticeable, and the gap, how long it stayed down there.
What exactly is in this ISM manufacturing index itself? What's this comprised of?
It's pretty similar to the LEI, but specifically for the manufacturers, we're looking at the demand for manufacturing. We're looking also at consumption, so things like the amount of production that they have, the amount of new orders that they're getting, but also a very important portion there is inputs. And for them, that's input prices. And again, just like the LEI, we're seeing a steeper drop in the pricing portion of the index compared to some of the other areas like the demand segment of it, which again, it just goes to show that the Fed's interest rate hikes are having the intended effect.
Right. If their costs are going down, eventually ours are too.
Yeah.
I think this is a great chart here because Jose just mentioned a couple of great points, right? In terms of, it is how steep the manufacturing PMI goes down, right? And that's really indicates a potential recession. And here at 48.5, it's not horrible. It's not down a lot, but it's down a good amount. But it's similar to what we saw in 2016. And for those who remember, that was with us back then. That was when the energy crisis first happened. When energy prices fell, that really caused I would say a mild recession in the Midwest, right? If you're anything related to the energy industry, the oil industry, lived in Texas, Oklahoma, you felt that recession here in this one, but didn't really spread across to either coast if you were not in a non-energy related capacity. Here, back in 2012, that was the pigs crisis in Europe, right? And so that caused a slowdown, but didn't really, both those cases led to a mild recession here in America, but not really a broad-based recession on a wider scale. But yeah, these big drawdowns here in 2001, 2007, 2008, and then obviously during the COVID one, that's pretty big. So, with our thinking here, with everything that Jose mentioned, we do think that with the leading with all the leading indicators that we're looking at, including those three that Jose just mentioned, we do think that recession is very likely to happen. We don't know when, but we think it is going to happen, and probably in the next few quarters, but or so. But it doesn't tell us how strong it is, right? Because as I said, we've had mild recessions and especially back in 2016. But we do think that the current outlook for this recession right now is going to be pretty mild. And the reason why we think it's going to be mild is really for several reasons, right? And the biggest reasons that we have are the strong job market, right? The strongest state of employment in America, and the huge amount of savings we've had too. And so we talked about this in the past, and you can see this here again here. This is a chart of unemployment rate, the white line here in America. No surprise, I think we've heard plenty of news articles talking about how strong the job market here in America is. Unemployment rate is still sub 4% here and continues to be sub 4%, right? Even after all the tech layoffs you've heard about, Google, Microsoft, Amazon, you see all these big names, these big household names announcing huge layoffs. But that really hasn't affected the unemployment rate, and that still stays below 4%. Part of the reason why we think is that there's a lot of job openings, right? And we look at that as the JOLTS, or the job openings statistic. And that's the blue line here. And yes, the job openings have come down a little bit, but that's probably one of the biggest surprises we have. This is the job openings is still stayed pretty healthy. Have almost 7 million jobs, right? And employers are still looking to add headcount, even despite the slowdown in the economy, the slowdown in the consumer, and the slowdown in the higher wages too. And so that's been a really positive thing. I think that's really going to help make the recession a little more mild than in the past. Also, on top of that, and not only just because the job market is strong, we're also finding out that workers are getting paid more too. And so this is the same data, the unemployment rate in the white line, graphed over. Instead of the JOLTS, the blue line is now the job is the wage increases. How much have wages grown recently? And so you can see when unemployment has started really coming down quite to low levels, the wage gains, the increases in wages have really taken off. And I know it's still not enough to keep up with all the high inflation that we've been seeing, but it helps out a little bit. And that really goes to show you how strong employers are paying their employees and all the wage increases there. The good thing to note though is that you're also seeing this effect more pronounced on the lower end of the wage scale too. And so I think the people that need it the most probably seeing the highest wage increases in the past few decades. All this increased wages, all the strong job market really has led to another thing too, is a tremendous amount of savings that has gone on in the market, right? And you can see this is a graph of how much we've been saving and how much we've been spending recently too. And so the blue line here is as a percentage of how much Americans have saved. And generally Americans don't save that much. You're talking about 1 to 2% in savings, right? And sometimes it's negative. During COVID, obviously, just like I'm sure with all you, and myself, we started saving a ton. My wife and I started saving a ton. We weren't traveling, we weren't going out to eat as much. We were stuck at home. And so our savings rate went up, which causes huge shaded blue area to also go up too. This is the amount of cash that Americans had stored on the sidelines. At its peak, it was $2.1 trillion that Americans had in the bank and set aside. So that was a real big reason why I think we saw huge increases in spending, like Jose was talking about, and why everyone rushed to buy a home. Then that started reversing itself. That actually started reversing itself in about middle of 2021, and when we started seeing higher inflation, you notice that the cash started being depleted a little bit. Americans went from net savers to actually net spenders and started spending all that savings that they had built up. A lot of us would do, I think, as I said, higher inflation, but a lot of it was just to keep up and go out, right? Americans were locked up for a couple of years now, and they wanted to go out and take that trip no matter what, no matter how much airline tickets would cost, no matter how much gasoline was. They were like, we're going out no matter what. And so Americans started not saving as much and actually spent down that savings. And you saw this decline in the amount of cash that was on the sidelines. It went from a peak of about over $2 trillion to just under $1 trillion today. And that's still a good number. And so this is kind of a good news, bad news chart for me, right? I still think with about $1 trillion in excess savings, I think that gives the economy a lot of buffer to handle a lot of the shocks that we've been going through. But it is going down at a pretty rapid clip, right? And so that's something that we're looking at very closely. And this can really, once it starts getting worse, I think you have to be worried about the state of the consumer and how strong they can be, and things like credit cards and delinquency rates and such like that. But so far, I don't think that's going to be the case, right? I do think one of the biggest reasons why Americans have started using all this excess savings was the high inflation and the high prices for everything that we've been spending. And it does seem that we've really reached a peak in that. I think inflation concerns did peak around October of last year, and they've been coming down since then. And so one of the ways that we've been tracking it, and I'm sure you follow CPI or core CPI and all these different measures of inflation that the Fed and Wall Street uses. One of the more recent ones that Wall Street has been using, something called the super core inflation, right? Core inflation minus energy prices, minus food prices, and minus housing. Because I think housing is a relatively sticky cost, right? For some people that own their home, it's quite sticky. For some people that rents don't necessarily reset every day, right? Rents usually reset about once a year. So that's really a bit of a lagging indicator. So some Wall Street economists decided to say, let's look at supercore. Just take out the food, energy, and housing, and stick with just services, right? Because that's really, the service inflation has been what's really high the last few months, with airline prices and such going up. And so that we're noticing a pretty dramatic decline in super core inflation. And that's been really declining for the past few months now, almost a whole quarter now. And hopefully this will continue its trend. And if that continues to trend, I think if inflation continues to ease up a little bit, and it already has, if it continues that path of slowing down here, I think that'll be a good thing. That'll hopefully allow the Fed to slow down, and it'll give some consumers a little bit more savings in the bank.
It's interesting. You can see that at this point, it looks like super core is well below where we were at the end of 2020.
Yeah, it's coming down. So it's good. It's a little higher, but we'll see. And hopefully, with this goes up the other indicators too. Energy, food prices. Everyone's talking about egg prices right now and chicken prices, and ultimately housing. I think that'll be the biggest X factor is to see housing prices.
Well, and used cars are. It seems like those prices are starting to come back down now as well.
Yeah, I hope so.
In the market then, huh?
Yeah, right. So all this leads to really why we're here, right? And we talked about our base case for what we think that what's going to happen with the economy and with consumer spending. But really, what does that mean for your portfolios and how we're positioned portfolios, right? Because we're not just all stock investors or bond investors. We have a little bit of mix, and we do believe in diversification. But just to take a step back, we do want to remind you that we are generally long-term investors. We generally don't have most of our clients have longer-term timeframes, 5 to 10-year timeframes. We have some portfolios that are short-term in nature, but those are kind of segregated out. But most of our clients and strategies are meant for the long term. And for that reason, we're investors and we're not traders, right? We're not day traders or we're not swing traders. We're long-term investors. We take long-term positions in businesses. And businesses that we like to own, right? And we want to take a business owner perspective, be a partner in these companies. When we say that, that really means that we have to really be confident and comfortable for holding a position for a long term. And what gives us that comfort and confidence is buying a company that has a strong economic moat. They're doing something different. They're doing something that has a durable business model. They're making money and many times free cash flow, or they have a nice operating margin. So that means that generally they're more mature companies. And we want to buy them when they're with a margin of safety. Buy them when they're a little bit cheaper, and they get some cushion in case we're wrong. So with that said, we still think that stocks are generally the place to be, right? It's hard pressed for me to think of anything else besides stocks when you think of innovation and growth and higher profits, and especially American companies really offer that value, offer that potential for investors, right? When we look at not just 1 year or 2 years out, but when we look at 5 years or 10 years out, I think stocks are really the best place to be. That's really who's going to make money, who's going to generate that. And when we look at companies, profits are a big part of it, right? And we still think that American companies are going to earn more and more profits. And you can see this is a chart of profits on the S&P 500 broken down on a per share basis for the last few years. And you can see that during the 2013, 14, 15, profits were relatively steady. This is the modest recession we had in 2016, by the way, where profits were relatively flat. Saw a little bit of growth, and then obviously the decline in profits during COVID to about $140 a share. And then post-COVID, we see this huge jump up in profits, right, per share, over $200 a share. And that continues to be on that trend higher. We could debate how accurate these forecast numbers are. The shaded numbers are forecast, and the solid blue ones are actual numbers now. But we can debate on that. But we still think that over the next few years, we think that companies, especially American companies, are poised to do really well and regain that profit growth that we're quite accustomed to. And so one of the biggest reasons we think that companies will still make a ton of money is that we still think we're in a growing economy, and margins, right? Profit margins for large American companies are very healthy. We are looking at profit margins here on the white line here for the S&P 500 over the last few decades. And you can see here, we are at some of the highest profit margin levels in decades, right? And yes, they've come down quite a bit. They come down from about 13 percentage points to about 11 percentage points. But even at 11 percentage points, we haven't been this high since the early 90s. And that's a tremendous amount. That really leads to a tremendous amount of flow through when companies earn an incremental dollar revenue for that dollar to really pass through to the bottom line for companies to be more profitable. And once companies are more profitable, they can do a lot with that, right? Especially if that drops to the free cash flow. They can invest, they can pay dividends, they can do all the things that we talk about when we look for a great company. And so that's pretty tremendous. Not only the only problem, I guess the contrary point to stocks right now is valuations, right? And this is a chart of valuations on the S&P 500. And probably one of the easiest ones is PE. Is this the price to earnings ratio on the S&P 500? And they've come down. Yes, they've come down. For a while, they're over 30 times earnings right after COVID, right? In late 2020 through early 2021, they hit a high of almost 30. That was probably the peak craziness we had with Zoom and Peloton, all some of these COVID names. And they come back to earth. And right now we're at about just under 20 times in the PE, Jose. That's okay, right? And I think that's relatively fairly valued here for the S&P 500, especially if you believe these profit numbers here, right? If you think that this is the right path, 20 times is probably an okay valuation for the market. Historically, when things get really cheap, during the crisis level, like we saw in early 2009, it got to about 14 times earnings. That's where the bottom usually is set, maybe 13 and a half to 14 times earnings, the bottom. And they've hit that too in 2011 and in past cycles too. So, relatively, I think 16 to 20 times is probably fairly valued. 14 is probably cheap. But right now, where we're at right now, I don't think the market is screaming value, but pretty fairly valued here. But I think good opportunities too.
So about where it should be, but not underpriced by any means.
Exactly. But it does leave us susceptible to that earnings chart that we talked about right here, right? If you think this is the correct path, then I think it's okay. But if we do see some decline in earnings, then I think they could be a little bit expensive. Exactly. And these numbers, by the way, have come down already, right? For calendar year 2023, which we're in now, initial estimates were closer to $250 a share. Now, after the past few weeks, we've come down to about $227 a share. So earnings are coming down, but they're still pretty high levels. What else? For the first time in a while, one thing we haven't talked about is bonds, right? And for the first time, with all the increase in interest rates, we're finally seeing safe assets start to yield something, right? And that's relatively attractive. And so what we have graphed out here are yields on not just Treasury bonds, but really investment grade bonds, right? You're talking about bonds from household names like Microsoft and Amazon to Johnson & Johnson and Pepsi, right? High quality American companies, the same companies we want to buy on the stock side. And wow, this is a huge reversal of fortunes, right? And so the yields right now are just under 5% as of today, as the average yield on these bonds here. Not that long ago, Josh and Jose, they were yielding about less than 2%, right? And so for safe assets, and this is the whole point for the last few years, there really wasn't an alternative for investors to look for safety, right? If you wanted something that was safe and something that didn't have the volatility of the stock market, you had no choice. Bonds weren't paying you anything, or they weren't compensating you for the risk you were taking. So you almost had to go into stocks, and that caused some of the bubbles that we saw in 2021. But now, for the first time in a while, really the first time in almost 10 years, bonds are yielding something. Bonds are yielding more than 3.5%, 4%. And at 5%, I think bonds offer a compelling value for that safety part of the portfolio. And even for clients with the shorter term time frame, they make it quite interesting here. And we're talking about bonds, by about 5-year maturities. And so what does that leave us? Well, so what we did next was we graphed out these kind of expectations, right? So we took a look at, and Vanguard helped us with this. They provided us with, in December, some expectations of future returns, right? Now that the market has fallen 18% for stocks, 12% for US bonds here, 20% for international, what's the future returns, right? And oftentimes that is usually the best time for future returns after a bear market like we just saw. And so we did that. They graphed that out, and that's on the left side here. So the higher the number, the higher the number, the better, right? But that's not in isolation. That's only in isolation. What Vanguard also did is they graphed out the expected volatility, or statistically, the standard deviation, right? How much volatility the asset class is going to go down, and relative to the returns. And as you can imagine, you want to, depending on the far right quadrant here is the high risk, high return, right? And so the first thing you can think of is emerging markets, right? That's actually one of the best asset classes so far this year. But emerging markets, they're expected to do between 8%, emerging markets, and global equities, like large US equities, by 8.4% over the next 10 years. But at what cost, though? We can see here, Jose graphed out the volatility. And so the bigger the circle, the more volatile it is. The farther to the right, the more volatile it is. So even though emerging markets are expected to do by 8%, their volatility is at 25%. That means it can be a huge swing, right, in the prices. And some years are going to be great, some years are going to be rough, like last year. And so, but look at this. This is the one thing that we notice. The U.S. equities, the expected return over the next 10 years for U.S. stocks is about 5.7%, with about a 17% volatility. Not bad. I think it's still better than what we saw the last few years, but still, I think that's going to get clients to a lot of their goals. But look at bonds now. U.S. credit bonds, you're talking about, same again, bonds from high quality U.S. companies. The expected return on bonds is about 5.2%. Very similar to that number that I just showed right here, right? And so at 5.2%, that's not that far from U.S. equities. And look how much less volatile it is. It's almost a third less volatile than U.S. stocks. So you see that's a really compelling. So for the first time in a long time, there's options for clients that want a bit of safety in their portfolio, and that's really healthy.
Yeah, it's a significant difference in the size of that bubble. right? And but the rate of return that you're getting is extremely close. So you really ask yourself, do I want to take more risk, if I'm not necessarily being rewarded for that amount of risk that I'm taking?
Yeah, and can you still make the volatility, right? And this year has been an interesting year, right? Because bonds are yielding about 5% for the whole. If you're to buy bonds at the beginning, you're going to get 5% for the whole year.
Yeah.
But look what the stock market has done this year, right? We're already up mid-single digits,
right? So
the market's already ripping. So you have that. There is some. There are some trade-offs to having bonds and doing that. So we do think bonds for the first time in a long time are compelling value. But the other question we get is the last question we get is really, well, great, Ben. You just talked about all the risk that we could have to the economy, to the job market, to profits. Is now a good time to invest? Should I be keeping my money in the market now? That's tough to say, but I would caution every investor out there to not wait for the data to turn, right? And that's probably one of the biggest things that a lot of our investors want to see is that I'm just going to wait till all the coast is clear, till we fix this debt ceiling crisis, till the election, until we the ECB or the Fed meetings. I want to wait till after that, and that's usually the wrong thing to do. And so what JP Morgan did was they graphed out almost every past crisis, and we took a few for you here, and they graphed out what happened with the stock market, and then subsequently they overlaid what happened with corporate earnings, with the economy, GDP, and the job market or payrolls here. You can see here, this is the last global financial crisis in 2007. You can see the S&P was the first thing to fall, right? And it really reached the bottom. I'll remember this clearly. It really reached the bottom in about March of 2009, right? That's when the bottom of the S&P 100, and it really took off from there. But look at it. The payrolls, the dark blue line, really didn't bottom for almost a year later. The economic growth, the economy, GDP didn't bottom for like another 6 months later. And profits didn't bottom for like another 3 months later. So by the time you got data about the economy actually starting to turn around, the market already started ripping, right? Already started turning around. And that's just not a phenomenon from the great financial crisis. That's the same pattern that happened even during COVID and during 2020, right? The stock market, the dotted blue line, really fell. I'm sure we'll all remember this one, but in February and March of 2020. But look, the job market didn't bottom for about another 3 months later. The dark blue line. The general economy didn't bottom until later that year, right? The red line. And then
the market was already rebounding at that point.
The markets were rebounding at that point, and then earnings, same thing too. And you see that time and time again during the 1980s, during the S&L crisis of the 90s. You saw that in multiple time frames. So I'd really caution investors to wait for it. We do think that the market did make the short-term low in the market did seem like it was in October of last year, and the economy is just trying to find its footing. If things get better or stabilize from here, I think that October low could hold. But if things do get worse, I think the market could take a little further down here. But I think things are starting to turn around pretty dramatically here in America, and even globally too. So yeah, so I do want to kind of go through a quick summary of everything we talked about here. I know we're running about on time right now.
Yeah, we're running time.
We do think our base case for the economy is a mild recession. I think that's pretty much consensus. You see that across the board. But watch out for there's a lot of broader risk out there, right? There's a lot of geopolitical risk. I don't need to mention Ukraine and Russia. That continues to be an issue. But we have issues in the Middle East and in Asia too. So those are things to watch out for. We continue, from an asset allocation standpoint, we continue to stay overweight equities. We still think equities are still the best place to be for long-term timeframes that are interested in growth, but that comes with some higher risk and volatility. And so with equities, we think it's still the place to be, but valuations are a little bit expensive and they've been a little more volatile. Focus on U.S. companies, but don't just look at U.S. companies. Look outside the U.S. You're starting to see international markets, emerging market countries do quite well this year, really thanks to a weaker dollar. And look at bonds. Bonds, for the first time in a few years, offer a compelling option for many clients. They're very attractive for clients that want the safety part. And in that case, we would stick with high quality bonds with intermediate maturities. And when I say that, I mean about 5 to 7 year maturities, even shorter in many cases. But look at bonds for that safety part of the portfolio. Thank you.
All right. So Ben, Jose, thank you so much. We'll go ahead and we'll move into the Q&A portion of the session today. So just as a note for everyone, if you have any questions on anything that we've talked about, questions about what's happening with the economy moving forward that we didn't cover, please feel free to go ahead and submit those using the Q&A tool, right? So you move your mouse around on the screen at the bottom, it'll say Q&A kind of towards the middle, click that and submit your questions in that way. And then what I'm going to go ahead and do to allow you some time to send any questions over, we're going to address some of the questions that were actually submitted before today's event. And so the first one that had come up was really, Ben, could you define soft landing? And if we hear it in the news all the time, right? They're talking about soft landing. Do you think it's reasonable that could potentially happen? I know here we've kind of said we think recession's coming. What is a soft landing? Do we think it's something that could happen?
No. It's looking more and more likely with inflation cooling down quite a bit, and hopefully the Fed pausing. We'll know more next week when the Fed meets on the and announce their decision on the 1st. But I really equate a soft landing to, and I've used the term in the past, as a mini recession, right? And I do allude to what happened in 2016 when we saw pretty much an energy recession that really affected the Midwest, the Midwest of America, right? If you're in Texas or Oklahoma or Tennessee or in the energy sector, you got hit a lot harder than the rest of America. And in many cases, you didn't even feel it if you're on either coast, right? If you're in technology or healthcare, you really didn't notice. We probably didn't even notice that we had a recession, a mini recession in 2016. So that's how I define a soft landing, is that we do have a slowdown in financial conditions in the broader economy, but it doesn't really get spread. People don't lose their jobs. People are getting unemployed. Companies aren't going bankrupt. And that's how I define a soft recession. And that really separates, as I said, something like we saw in 2016 to something that we saw in 2008 or 2009, where in 2009 that was a serious recession, right? That was a crisis where a lot of people were not just losing their jobs, but they're losing their homes. We're so concerned about a systemic-wide breakdown of the system, right? And that's why people were rushing on buying safes. That's why I bought my first safe. When people were were storing cash in there and worried about just banks, right? Could I go to Washington Mutual and use their ATM today? Right, and so that's the kind of some of the concerns that they had, and so that's why I worry about, and so I think that right now, if we have a mild recession or a mini recession, as I said, a soft landing, and doesn't spread and become a bigger crisis, I think that's pretty palatable for the economy
right now. All right. Okay, the next one here. So I pulled the email up, and it says, what are your plans to protect investors' assets from the fallout due to the upcoming resistance to raising the debt ceiling? It's a good one.
Well, I mean, this is a tough one, right? This is such a big headline recently, and I honestly think it's more of a political issue than a financial issue. But it's these political issues are becoming bigger and bigger issues that could affect the whole system, right? And I probably wouldn't have said this a few years ago. But now, once we started making the debt ceiling an issue by about 10, 15 years ago, it seems like it's become an issue almost every few years now. And then after we saw the fight for the speakership in the House, politics are at a very escalated levels, even amongst people in their own party. And you're starting to see that. And I think that's quite a bit of a concern. If Republicans can't all agree on something, then the passage with such a narrow majority is really tough. First of all, I don't necessarily think that the debt ceiling debate is hugely impactful for the markets, right? And I'm not too concerned about the Treasury defaulting on U.S. government bonds. I think that's a very, very low possibility here. Remember, the Treasury is mandated by the Constitution to pay down its debts. If we do hit that debt ceiling, which is possible, and America is one of the few countries that has to deal with it, right? This is not primarily a European issue. We have a political mandate to have a debt ceiling on the Treasury. What's going to happen? But think about this: what's going to happen if you guys? I know you guys aren't close to this. What happens if you guys hit your limits on all your credit cards? No one's going to loan you any more money. You got bills to pay, and you hit your line, right?
Gotta sell some stuff.
You got to sell some stuff. You got to cut back on some expenses, right? And you're going to cut down on the gym membership.
Yeah.
Some of these discretionary expenses, and you're going to see the Treasury make those plans to do that, right? They're going to start to conserve cash and cut down on some of these discretionary spending issues. I was camping the last time. Well, I was about to go on a camping trip the last time they had a debt ceiling debate here, and my camping trip got canceled because they closed the national parks. And so you're going to see that happen across the board, where the federal government is going to close down a lot of federal agencies and a lot of federal issues, and you'll see that happen. I think the issue really will come to a head towards the end of this year. I was reading a Goldman Sachs report talking about how the Treasury is really going to start running out of cash really towards the end of the year, not really right now, right? We're talking about this at the end of January here, where we're coming upon the debt ceiling. Remember, the Treasury is going to get a huge influx of revenues from every American, which we call taxes, in the next few months. That's going to buffer the coffers a little bit, and they're going to slow down their spending too. So I think it's going to be a very hot political issue, but I don't think it's going to be really too impactful for the markets.
All right. Hope that answers your question. Okay, so the next question that came in was, I could see this question going two different ways. So we'll read it and we can decide how you want to answer it. But what is the likelihood of a very long recovery? I'm sorry, a very prolonged recovery, in quotations here, more than just a couple of years? Yeah. Especially for your senior investors, what is the best way to preserve assets if this happens? So the reason I can see this either kind of talking about recovery from last year, right? Market drops, 19+% last year, and we're trying to recover from those losses. Or I could see this being prolonged recovery, meaning, the economy as we come out of this, potential recession and inflationary environment and all that being prolonged. I'm going to take from there.
I'm going to take the point of view where I think it's really, you're talking about portfolio's, right, and how that impacts themselves, right?
Right.
Generally, our retired clients don't care about the job market because they're retired, so they're not looking to go back to work. But I really think it's more about the portfolios. Everyone defines a prolonged recovery a little bit differently, but if you look at the past, generally it takes about 2 to 3 years for you to make up the loss in the stock market. And it takes about the stock market to go back to its previous highs. It's about 2 or 3 years, right? And so that's historically how long it takes on average. So a prolonged recovery will probably, in my book, last more than 3 years. It takes longer than 3 years for the market to get back to its highs. So if that's the case, then I would look at other asset classes, right? If you cannot, and I think that even if we are on track that the market is going to go back to its highs within about 3 years, I think it's going to be a very volatile one, right? Because I think that inflation has been so high and the amount of stimulus we put into the system and now taken away from the system has been tremendous. We've seen these huge peaks and valleys in the last few years. And I think that we're going to continue to see that in terms of volatility for the next few years. So I think the market's going to do well, but it's going to be with a lot of ups and downs over the next few years to make that recovery. If there's a concern that this recovery will take longer than 2 or 3 years, and we'll prolong, in Josh's point, then I will look at other asset classes, right? And stocks are a compelling value here. If you're down maybe 10%, putting more money into bonds that are yielding 5 will mean your break even is about 2 years, right? And so that's why I think bonds are a much more appealing option for many investors that don't want to have that time frame, that don't want to wait out that 2 or 3 years that we talk about in terms of our investors' time frames. Mm-hmm. So bonds are a great place to be. Maybe readjusting your asset allocation, right? Do you need to have 75% in stocks? Maybe you should dial that back a little bit and reduce that if you can't handle the volatility. So that's the biggest issue. But it's been rough. You can see like this year the market's already up 5%. Yeah. So we've already gone about a year's worth of interest from bonds in the first few weeks of the year, and so stocks can do well, especially at these low levels.
It's just unforeseen as to what the future holds, where the bond is a little bit more, I know where I'm going to be, what's going to happen. I think this is twofold also, right? Because if we're talking for somebody that's retired, right? We're talking retirees, we're withdrawing and we're pulling from the portfolio, right? We need to be a little bit more strategic in what we're doing. But if it's a prolonged recovery, for those of you that are younger and you're still in an accumulation stage of your life, right? We're still working, we're still, 5 years plus away from retirement. A prolonged recovery is a good thing, right? It gives you a longer period of time to buy up good assets at better prices. You don't want it to come rip roaring back right away. I'd rather come rip roaring back right before I retire and stay low the entire time before that. So I can buy every couple of weeks, and you just keep stocking money aside and buying at good prices. So I think it definitely depends on what stage of your life you're at, your financial lifetime is.
Completely, Josh. It really depends on who you are, and that's why it's so important if that's your situation, if your time frame is really 2 or 3 years, then you got to come in, right? Meet with Josh and all the wealth managers that we have, or make sure your financial plan is dialed in, and let's talk about it, right? We can be tactical with your situation.
Okay, so the next question, this kind of piggybacks off the last one. It may have already been answered, but it's okay. We can kind of readdress it here. So it says, how would your recommendations change for investors in retirement? So I think we kind of just touched on that there, but I would definitely say that this year, we're definitely talking a lot more about the bond opportunities that are out there. And then there's definitely some conversation between, it can look really tempting to say, hey, it's 5% for a 1-year bond, right? I just want to take my 5%. Why would I take 4.8 for a 2 or 3 year bond? But I think there's something to be said for picking up a little bit more duration, pick up that maybe 4.8, 4.7 ish rate on a 2 or 3 year bond, because like we talked about before, if we go into recession, if interest rates do end up coming back down, those bonds themselves will be locked in a nice higher rate. I mean, there's definitely a conversation you can be made for somebody picking up maybe 5 years or something along those lines. My thoughts. Yeah. What about you guys?
I completely agree. I mean, I think that retirement's gotten more complex, right? And retirement is no longer this single time frame for many of our clients, right? I think retirement is there's multiple time frames, right? And we think about from when you stop working to maybe when you start drawing down Social Security to when you start taking RMDs and even post. And so there's you have many different stages of retirement, and how much money are you spending during different phases? What's the tax bracket? How much were your accounts are spread out? And so it really is so important to do a financial plan with our team and to see which stages you're at. And especially now with the Secure Act, right, with the new changes and RMD age being pushed out even further, really make sure that your financial plan is a tax plan and incorporates all that. And incorporating bond, incorporating some of these income products might be a much better option for you than the past, but maybe some buckets should be more growth oriented. So it's a very customized solution for everyone. So.
The next virtual event will be at the end of February 22nd. We're calling it Service to the Highest Degree. We're gonna get some new faces on for you here as we get our service team to hop in and share with you guys all of the tools that are there and available to make your lives easier as far as accessing your accounts, your portfolios, opening accounts, moving money, anything that you could possibly need as far as services related. So we're looking forward to that. That'll be the end of next month. Thank you so much. We appreciate everybody being here. Ben, Jose, thanks for your time.
Josh, Jose, thank you.
And with that, we'll sign off.
Take care, everyone.
Take care.